Today we are going over how the big beautiful bill is influencing healthcare for employers and employees alike. Hi, my name is Melissa DeWeese, and I've been working in the area of HR and employee benefits for over 20 years now. And I've worked with hundreds of employers, helping them reduce risk and improve employee benefits and improve systems surrounding employee benefits for a long time. So let's get into what we're going to be talking about here. Initially, when the big beautiful bill was announced, it was really viewed as an economic bill, and quite frankly, I was sleeping at the wheel a little bit because I did not see that they were adding all of these little bells and whistles into the bill that are related to employee benefits. If you're an employer, an HR manager, CEO, CFO, and you're concerned about how this latest big beautiful bill is going to impact you and your employees and their health care, that's exactly what I'm going to address in this video to the best of my ability. As of today, it's September 23rd, 2023, and news in and around the administration, the current presidential administration, seems to be moving very quickly. I have another video that's coming out where I will be going over some of the FDA and CDC changes that have happened. So stay tuned for that. But for now, we're going to focus on the big, beautiful bill. Let's get into it. All right. The first thing here is, how does it impact employees and employers? Big question. It's going to, or it has impacted telehealth coverage for high deductible health plans. It has expanded HSA. It has updated dependent care FSA limits. It has updated student loan repayment language and the ability for employers to offer that coverage. Enhanced employer childcare credit. This is a tax credit. Paid family medical leave credit. So these are all of the areas that we are going to go over. Let me start out by stating my little silly disclaimer that is super important. I'm not your broker. I'm not your financial advisor. I'm not your attorney. I'm not your CPA. This is not medical advice, financial advice, legal advice. This is not any advice at all on any scale, on any level. I am a lady on the internet that's been working in insurance and HR for 20 years, and I'm simply stating my experience and how I currently understand this information. And this is meant for educational and entertainment purposes only. Viewer discretion is advised. All right, so let's get into it. One Big Beautiful Bill Act. Probably going to insert a little sound of a board insert there of Trump.
Big beautiful bill.
Because he just went on and about this thing, and then him and Elon fought about it, or had their little WWE match on X, right? So these, on this page I'm reviewing, again, this is very high level, and as you see, we'll dive into the details of each of these, but this is the next layer here. So telehealth coverage for high deductible health plans is retroactive to December 31st, 2024. So they backdated this to allow high deductible health plans to continue to offer telehealth medicine services to members on a high deductible health plan without having to meet the deductible. And we'll get into that. The second thing is the dependent care FSA limit increase. So it went from $5,000 to $7,500, and we'll talk more about that. Starting January 1st, 2026, just right around the corner, coming up faster than everybody wants to admit. All bronze and catastrophic marketplace plans will be considered HSA eligible. All right, right now you have to have a stamp on your plan basically that says you're HSA compatible, but going forward they're loosening that. Section 127 is allowed up to $5,250 annually in tax-free student loan repayment assistance for employers. We'll get more into that as well. Enhanced employer tax credit for childcare. All right. And paid family medical leave credit. All right. So the first one here is telehealth coverage. So the law, optional, not mandatory. Okay, so not just because they're updating this doesn't mean that your high deductible health plan is offering telehealth services with a $0 copay or low dollar copay or even waiving your deductible. This just means that this will allow the builders of the insurance plans to they're now allowed, if they have any high deductible health plan and they construct a high deductible health plan, they're not required to provide first dollar telehealth coverage. Okay. This is optional for employers. High deductible health plans are not required to provide first dollar telehealth coverage. Before this law, if a high deductible covered telehealth service plan before this law, if a high deductible health plan covered telehealth services before the deductible, employees would lose their HSA status. So now those companies and those plans can offer these telehealth services before the deductible is met, and the member will not lose their HSA status. The Safe Harbor provision is the One Big Beautiful Bill Act permanently extends the ability for high deductible health plans to cover telehealth services before the deductible is met without jeopardizing HSA eligibility. So people can stay on their HSA, and this again just leaves more flexibility for those people who are building these plans. Employer decision points, you're now able as an employer to choose high deductible health plans that do offer telehealth services, or if you are self-funded and building your own plan, you can certainly build this in and still offer an HSA. All right, so it gives those employers that really want to push people towards the telehealth and encourage telehealth, because we see time and time again, the more telehealth services there are, the more plan costs go down, and employees love it. I love it personally. Of course, not everybody loves it. I don't assume that everything I love, everybody else loves, but once people start using telehealth and get used to it, it's so much more convenient than having to go to the doctor's office for the sniffles or for the flu. Who wants to get out of their house when they're feeling terrible and go to the doctor? Isn't it so much better to just make a phone call and talk to somebody over the phone and get a prescription, go through the drive-through? You don't even have to get out of your car. It's just way better. And especially with kids, telehealth services generally, ear infections, eye infections, fever, cold, flu-like symptoms, COVID symptoms. Anything outside of that, usually it's recommended to go to an urgent care. But for sinus infections, low-grade fevers, things like that, it's ear infection, eye infection. Like I said, it's wonderful. All right, moving on to what changed with these bronze plans and these catastrophic plans. So current status through December 25th, or current status through December 31st of 2025, most bronze ACA compatible plans are not HSA eligible. So most bronze plans out there have a very large deductible, anywhere from $4,000 to $8,000 plus dollars for a deductible. For most people, that's a very large deductible. And even with that, those plans are not necessarily HSA compatible. And people want to get on this HSA, use HSA funds that are tax-free or deducted from your taxes or put into the account via deductions, pre-tax deductions. People want to use that money for their medical expenses and save on premiums, because the idea is that, let's say you currently have a gold plan or a silver or a platinum plan that has a $500 deductible, $1,000 deductible, $0 deductible, and you're paying $1,500 a month. And you can go on a bronze plan that's got a $5,000 deductible, and it will cost you $1,000 a month. So you're saving $500 a month, $6,000 a year. The idea is that you take that savings, whatever you're saving from downgrading your plan and premiums, you put that into an HSA plan, and that accumulates over time. And you want the savings to be close at least to what your deductible is, so it justifies making that move in case you do have a catastrophic situation, or in case you do have a large claims year or high utilization, you're using the plan a lot, you get sick, get in an accident, things like that. So you do have to weigh those risks, but it can be a great tool for a lot of people. So the idea is expanding this, making it easier for people to use and gain access to these HSAs, especially if they have a high deductible health plan. Individual coverage only. This expansion does not apply to group plans yet. Hopefully it will at some point, but currently it's only for individual plans that are offered through the shop or an exchange. All right. So the expansion applies only to individual marketplace plans. It does not extend to small group plans or employer-sponsored plans. All right. Changes are effective January 1st, 2025. So all bronze and catastrophic plans on the ACA marketplace will automatically be considered HSA compatible, qualified, eligible, regardless of whether they meet traditional IRS high deductible health plan requirements. So there's a definition that the IRS puts out every year. It's usually updated, that states exactly what the deductibles have to be, that nothing is supposed to be covered under the deductible except for preventive services, period, end of story. And it can be strict. It's a little strict. So they're loosening that up. Premium subsidies still available. So individuals can still receive premium tax credits on bronze plans while also being HSA eligible and using an HSA starting in 2026. Okay. The FSA change. Yay! This is so exciting. I was just talking about this in another video that I recorded a bit ago, talking about what the current limits are on HSA or FSAs. The government just loves to mix up FSAs and HSAs, and they're just one right after the other. And my brain just gets them all mixed up and I say the wrong thing. We talked about HSAs, now we're talking about FSAs. And there was an FSA change for dependent care. So this is very exciting. I completely agreed that the $5,000 for a family was too low for dependent care limits. Currently in 2025, the dependent care limit on an FSA is $2,500. And if you're married and filing jointly, you can set aside up to $5,000 if your employer offers a dependent care FSA. Starting in 2026, those numbers are up. It's now $3,750 for a single and $7,500 for a family. This is optional for employers. Not every employer even offers an FSA. And even if they do offer an FSA, it doesn't have to be this high. Some employers do keep the numbers lower because they're afraid that a new hire will come in, use the money, and then run away and not pay it back over the year via payroll deductions. That is a risk of an FSA. But for these larger employers that statistically it ends up working out just fine and they're not too worried about it, many of them do offer FSAs and those numbers are going up. So if you're a CEO, CFO, HR manager that offers an FSA, please know that you can increase these numbers starting January 1st, 2026. No inflation indexing. So FSAs, unlike other limits that the IRS is control of and other government agencies control, this is not adjusted with inflation. It hasn't been adjusted for 40 years. So we are very happy to see this adjusted. Business tax credit. So there's this thing. It's a childcare business tax credit. Larger businesses do take advantage of this. I'm going to explain exactly what it is, what the current law is, what it is, and give some examples on how companies are taking advantage of this. And again, I'm not a CPA. If you're interested, please reach out to your accountant and CPA and tax attorney. Okay. So business tax credit, current law through 2025. Minimum is $150,000 annual tax credit for the employer, or that's the maximum. Did I say minimum? All right, so let's start over. So this is the business tax credit. The current law in 2025 is maximum of $150,000 annual tax credit for an employer. The tax credit is equal to 25% of qualified childcare facility expenses. So the employer has to spend 300, 600, at least $600,000 on a childcare facility for their employees to write off and get a credit of 25% of that to the max of 150,000. So that's 150,000 times 4 basically. And yeah. Starting 2026, the maximum is increased. The most an employer can write off is $500,000 for most employers. Again, check with your CPA for that provision. For most employers, see if you qualify, if you're spending or you want to spend money on child care facilities for your employees. Large businesses, who's taking advantage of this? Two of the biggest examples are Google. Google does have an on-site child care center at multiple campuses, and they could claim hundreds of thousands of dollars in tax credits this way. Johnson & Johnson contracts with KinderCare for backup child care and qualifies for the tax credit that way. So it's whether the large employer is building a facility themselves and offering it in-house and paying that payroll to those child care providers on site, or if they are paying another business that offers childcare that money. They can write it off either way, from what I understand. Small business examples. So a small law firm contracts with local daycare to reserve 10 spots for its employees. This costs the company $100,000 and they get a $40,000 tax credit in 2026. That's pretty awesome. Okay. Manufacturing company builds on-site. They build an on-site daycare. It costs that construction company $300,000 to construct that child care facility, and they would then get $120,000 tax credit, or could be eligible for up to $120,000 tax credit. So the percentage changed. That's one thing that isn't here. So I believe it went up to 40%. So it was 25% of the cost up to $150,000, and now it's 40% or more of the cost of the child care facility up to $500,000. So big jump there. Okay, paid family medical leave credit. So this has to do with FMLA, but it is not FMLA, and it is not changing FMLA in any way really at all. So basically has to do with FMLA insurance and credits for purchasing that insurance. So real world small employer, how this would impact a real world smaller employer. I'm going to give an example. A 25 employee law firm purchases PFMLA. So that stands for paid family medical leave insurance. And let's say this group of 25 attorneys, they pay $15,000 annually in premium for this policy, this paid family medical leave insurance, okay? And they can get a tax credit for spending that money of 12.5% to 25% of the cost of the premium. So they would be getting back $1,875 or anywhere between $1,875 and $3,750 for spending $15,000. And that would be their annual savings in this tax credit. No employees need to even use the leave for this credit. All right. Impact on employers, there is no size requirements. Unlike FMLA, which only applies to employers with 50 plus employees, this Section 45S tax credit is available to employers of any size. Starting 2026, employees only need 6 months of employment, down from 12 months of employment, to qualify for the credit eligible leave. New insurance options. So small employers now can claim the credit for PFML insurance premiums even if no employees use the leave, making it easier to budget and plan. So that's been loosened up as well. Talent attractions. So this has to do with student loan repayment benefits. So Section 127. This is a student loan repayment plan that employers can offer to their employees. As we all know, repaying student debt is a huge burden on younger people and for employees who are required to just to get the job they have to go to school for multiple years, like an engineer or doctors, medical, things like that. So talent, this helps attract and retain top talent. Student loan debt is a critical concern for 43 million Americans, making this benefit extremely attractive, especially for the younger generations. It makes a competitive differentiation between you and another employer. So with permanent status on this new benefit, employers can confidently market this benefit long term without worrying that it's going to be X'd in future years or that it has an expiration on it. So there's no expiration on this bill, on this piece of the bill. Tax benefits for the employer. An employer can contribute tax deductible, and it is considered a business expense. No payroll taxes on up to $5,250 of annual contribution. So there's no payroll taxes on that. Flexible implementation, employers can choose monthly payments of $100 to $200, lump sums, or a hybrid approach. So you can pay the employees upfront a flat dollar amount. You can say, hey, we're offering this loan repayment program. You can contribute monthly to it. We're going to do a one-time contribution of $1,000. Or we're going to do a one-time contribution up front, $1,000 and $50 every month, or $100 every month after that. So you can do a hybrid, just pick a lump sum, or pick a monthly amount you're going to contribute to that benefit. All right, so that's it. Those are the Big Beautiful Bill updates, and hopefully you found that useful. If you know any HR managers out there that would find this information useful, please share it. Please the video, comment, and thank you for hanging out until the end. We will see you next time. Bye-bye.